Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Gold, there's gold in them there hills. What's going on with gold, Daniel? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about the golden rule. AAA, for those who may not know, the golden rule is those who have the gold make the rules. Yeah. And gold has just been on a tear. By the way, it's nice to see you. It's been a little while since I've gotten to see you on one of these shows. So it's nice to see you. You're looking good today, AAA.
Well, it's good to be seen. And, life is crazy, as you well know, Daniel. And, but yeah, I'm glad to be seen and glad to be here in the studio with our radio audience and YouTube audience. I always tell people, Daniel, that, when people call in, I say, I'm so glad to talk with you because, what, Daniel and I have a lot of fun on the show. But, it's kind of still one-sided. We're just talking to each other, and it's going out into the airwaves. But when you call in and I get to talk to you, I'm like really excited because I get to see what the feedback is and what's really coming across to people. I love doing the show with you, Daniel, and love being able to educate thousands of people a year. And as well, this is all about educating people because people don't know what people don't know. And there's not a lot of venues, there's not a lot of networks that are out there just to help educate people. I mean, YouTube has a lot of stuff on there, but usually it's somebody trying to sell you something. And we're just trying to educate people. And between our radio show, our podcast, workshops, we educate thousands of people a year, but we only take on maybe a couple dozen new clients per year. And so I love being able to do the show and for eyes to be open to people. And I love the fact that you and our radio audience are listening today, or you on our YouTube are watching us today. Hey, Jay, good to have you with us, man. And I know my friend Jay is watching. And, so with that, it's good to have you here because you know what? I want to congratulate you because there's a lot of people that don't know what they don't know. And you know what the egregious thing is? That they don't want to know. And there's a lot of people who are not listening to this show today because they don't want to know. But you're listening because you want to know, and I congratulate you. Because if you want to know, you can, it's like Jesus said, if you shall know the truth and the truth shall set you free. He said that to the Jews who were studying God's word. And that's where the truth, he says, if you abide in my word and I abide in you, you shall know the truth and the truth shall set you free. And so we want you to be able to be set free with information, with truth that you're not going to get in many other places.
Yeah. So AAA, what's the big deal with gold? Everybody's talking about it. We've had clients come in and ask us thoughts on gold. Believe it or not, the big financial news organizations are talking it. The big financial asset allocators are telling people they should have 20 to 30% of their portfolios in gold. Warren Buffett has always said it's a pet rock. And it is kind of funny. He talks about how if people in space were watching, if aliens were watching and they watch us go and dig the gold up out of the ground, pull it out of the ground, refine it, and then go put it back in vaults in the ground.
Yeah, well,
Daniel, what are these people doing?
Daniel, that's really funny. I think you might be too young to know or to remember. Back when I was in high school and college stuff, they had actually these things that were pet rocks. They were rocks and they'd have pictures on them or all kinds of things. And people would actually have pet rocks. So when he's talking about pet rocks, that's what he's talking about. Their pet is a rock. Where today, a lot of dogs and cats and everything like that. But that's a great question, Daniel. What's the big deal about gold, right? And there's a lot in the press, a lot with our clients, a lot with people, listeners from the show. We just did a show on gold back in July. And here we are in October, November, somewhere in there, and we're doing it again. And previous to July, it was in 2023 when we did a show on gold. Right? Because we've been actively investing in gold and talking about gold for actually over a decade now. Because people have been, ever since 2008, people have been coming and say, oh, I want to buy gold. And they'll say, I want to buy gold. And I have to ask them, well, why do you want to buy gold? Do you want to buy gold as an inflation hedge? Do you want to buy gold just because, like the Bible says in the end times, gold's going to be worth a lot of money? And Or do you want to buy, why do you want to buy gold? Do you want to buy gold as an investment, right? And that gets into some stuff we're going to talk later on in the show, right? Because it's like, what's your purpose for buying the gold and what's your investment strategy, right? Because that's all part of it. But ever since 2008, when the market dropped so much, 50% with the stock market, the S&P 500, the Dow dropped 50% in 2008. That's huge. And people been wanting to know about security, and they think of gold as a secure item. We've got clients coming in who are saying, okay, I hear about gold. All the talking heads are talking about gold. What's your view of gold? So we're having this show today for our clients, especially prospect, people who your listeners in it. Great. Educational, right? We're talking to our clients, to our team to be able to help understand what's going on with gold and why we're doing this and what we're doing. And we've been investing in gold for our clients for what, 15 years plus, I think, at this point. And so we know a little bit about it. No, we know more than a little bit, but we're going to help other people know about it today, right?
Yeah. And so if anybody's been sleeping under a rock and they haven't got the message, gold has been going bananas, right? 1 year, rolling 12 months, it's up 47%. It's beaten the S&P 500 over 5 years, over 10 years, and over 25 years. Now, for all those index investors, S&P is the best thing. I know you think I'm a heretic saying that, but these are the real numbers. Even when you reinvest the dividends from the S&P, that wonderful, what is it, 1% dividend?
Right.
Even when you reinvest that dividend from the S&P, gold has trounced the S&P over 25 years, AAA.
Yeah. Exactly.
The numbers are crazy. 1 or 2% people don't think is a lot, but when you compound that over 25 years, it can make
that's right.
a big difference. And the difference would be basically if you took $100,000 and put it into gold in January of 2000. Today, it's over $4,000 an ounce today. But if you had done that and not sold, you'd have about $1.45 million in gold today.
Yeah, $500,000 more than the S&P 500 if you did the same thing with the S&P 500 at that same time, which is 50%. That's 50% more than what you would have had with the S&P 500. Like you said earlier, 47%, but 50% more. Instead of having $900,000, you would have $1.5 million if you put $100,000 in January of 2000, and in both the stock market as well as gold. So
that's
you're listening. Let me give our identification here. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is the golden rule. He who has the gold makes the rules. And we're glad to come to you today. And we have a white paper. We have a report that we put together for the show today that I think you're going to enjoy and be able to help you. A lot of times people are interested in gold as financial defense, whether it's a hedge against inflation or it's to protect your assets and to preserve your assets. So this is called the importance of financial defense. And we'd love to put that paper in your hand for free by calling us, no obligation, by calling us at 800-725-7616. There's an operator standing by to take your call. Just ask for it by name. The paper on financial defense. Okay, 800-725-7616. 800-725-7616. And you listen to Financial Strategies. This father and son team coming to you to help you know what you don't know. Daniel, that's astounding numbers when we're talking about if you put $100,000 into the S&P 500 in January of 2000, or $100,000 into gold at that point. Today, you'd have $1 million, just shy of $1 million, 900,000 or so, maybe just shy of $1 million, 980 in the S&P, but you'd have almost 1.5 million worth of gold today. We're talking total return there, folks.
Total returns. We're talking total returns. And that's a difference of 1 or 2%. but you compound that over 25 years and it makes up that crazy difference between, rounding these numbers, $1.5 million compared to $1 million in the S&P. And so that pet rock was pretty nice. Now, AAA, when you and I do reviews with our clients, we typically go up and we draw on the board and we show people what markets did between 2000 and 2013.
Right.
And some people may say, why are you choosing those dates? Well, there's plenty of dates that we could use in market history like
we have
that.
to use something.
That's because that's recent, and that's showing a 13-year period. This 13-year period where 2000 to 2013, the market did a lot, but you didn't make any money.
Right.
It dropped 50%, it got back to even, and then it dropped 60%, and then you got back to even 13 years later. And looking at the chart is crazy, because when someone's sitting there and they're thinking about retirement, and they're saying, if I stomached that 50% drawdown, and a lot of them did this because they were younger when this happened and they watched it in their 401k. So a lot of them know what the feelings were, even though it was so long ago. And they say, if I didn't sell, I was able to hold on for a 50% drawdown, got my money back. I invested 100K, got back to 100K. Then it dropped. That 100K dropped down to $40,000. And I didn't sell again. And I wrote it back up. 13 years later, I'm back to my 100,000. And since then, it's just taken off and gone up. But that 13-year period of time, they all say, that is unacceptable to me. That is absolutely unacceptable. Not only can I not have a 13-year period of time of no money, of making no money, but I can't have those drawdowns either, because that's unacceptable at this point in my life. And we say to people, well, that's what you get when you invest in the stock market. That can work. When you invest in S&P, that can work for young people because they're what's called dollar cost averaging. They're buying shares as it goes down. But that doesn't work when you're close to or in retirement.
And that's one reason why people roll over to 401k, so that they can switch to other kinds of investments. Because most 401k plans don't do gold in a good way. And if you had bought $100,000 worth of gold in 2000, in 2013, when the stock market was just getting back to where it was, where your 100,000 would just be 100,000, gold would have been, your $100,000 worth of gold would have been somewhere in almost $500,000 at that point. So people are enamored with the stock market. And the problem with the stock market is it's very emotionally driven, where gold is not as emotionally driven. It's driven by other factors besides emotion, where the market is mostly, especially today more than ever, two things: supply and demand, the amount of money going into the market, and the emotions of the people who are buying and selling in the market.
The flows, the flows. Okay. Yeah, the flows. And the flows control a lot of these types of momentum-driven assets, right? Like the S&P is really a momentum-driven asset, like you're saying, with the emotion, but it's also from the flows from 401k. So money's forced into 500 stocks. What do they have to do? Well, they have to go up. It doesn't matter if it's good value or not. That's what's going on with gold right now. We go through these cycles in gold, right? There's been many, but the first major one was because it came off the gold standard, so it was a real market, right? And that was from the early 70s up into the early 80s, where it just took off, and it went from $35 an ounce up to, I think, 400 or so. Yeah. And then it didn't do anything. It didn't do anything until 2001 to 2011, and it hasn't done really anything from 2011 until 2021, 2022. Right. And now, where's it going next? Is 4,000 the peak, or are we going to keep going up? And that's what we're going to talk about today.
Yeah, that's very good. Yeah. All right. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is the golden rule. He who has the gold makes the rules. And with that, we have a video book that we'd love to put in your hand. If you like that, for free, no obligation. First 5 first-time callers at 725-7616. This video book is a handheld book that has 3 different videos on there talking about how you can have a secure and stress-free retirement. And as they're short animated videos that are easy to watch and fun to watch. And we love to put this book in your hand for free. It's an uncommon thing, but we love to put this in your hand for free that you can have it by calling us at 800-725-7616, 800-725-7616 for your free copy of the video book. Call now.
Important financial question. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Source's investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Agemy.
If you don't know history, you're doomed to repeat it. And we're talking about gold today, the golden rule. He who has the gold makes the rule. If you had bought gold 2 years ago, today you're in the money. If you bought gold coins 2 years ago, today you're in the money, or in the black, as they say. You made money, not just a little bit, you made a lot. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about gold, the golden rule. And AAA, the golden rule is those who have the gold makes the rules. When the U.S. became the world power and the dollar basically became the world's trade, right? The world trades in dollars. It was because the U.S. had all the gold and they came together and said, basically, the dollar is backed by gold. So if we back the world by dollars, the world is backed by gold through the dollar. Well, in 1971, Nixon took us off the gold standard and all that changed. And now the world is just fiat. It's just based on decree, right? The money around the world is backed up by aircraft carriers and military and law.
Right.
That's it.
Right.
There's nothing that is being backed by, some may say the US dollar is being backed by the petrodollar. The petrodollar is because we give protection to Saudi Arabia. That's the oil trade, and the world trades in oil, and that's what's been backing the dollar for a long time. But now there's things where oil is being traded in Bitcoin, oil is being traded in the ruby and the yuan and all kinds of stuff. And so that could be part of the reason why gold is taking off to $4,000 an ounce.
Right. It's interesting, Daniel. I'm smiling over here because I'm laughing inside because you're talking about fiat money. That what gives it value is military and whatnot. So you know what? Taking that to the family, you know what that is? That's a father saying to his 15-year-old son, because I said so.
Yeah.
What 15-year-old son says, okay, Dad, because you say so, I'm going to do this, right? Not very many, right? Now, with that...
It works while it works.
Right. It works while it works, right? Now, it might work on a 10-year-old son, right? But it's not working on and certainly not an 18-year-old son, right? And so that's what's going on with that, right? But then again, that's where I started with, if you don't know history, you're doomed to repeat it. And I just got to say this when we're talking about this, Daniel, right? On my screen, I'm not going to go into all the details that I told you, Daniel, but on my screen right now, radio listeners, there's an ad for a mutual fund. And this mutual fund it's a great sounding mutual fund. The concept is phenomenal, but I'm not going to touch that with a 10-foot pole because in 1999, I bought one like that, but what they were investing in, instead of investing in crypto, it was investing in .com companies in the same fashion. And guess what happened to that? It went belly up. So this one, even though it's a great concept, great thought, it's got sizzle to it. People are going to buy it because it's got sizzle. And that's all this fund company is interested in, is selling it. But that's where, if you don't know history, you're doomed to repeat it. If I didn't know and experienced that in the past, losing my money in that other one, or knowing about that other one, I'd be like, oh, Daniel, let's buy this for our clients. And there'd be a lot of people losing a lot of money. And that's not going to happen. So I just want to say that. So if we don't know history,
learn
right?
from history. Yes. And so
learn
what can we learn? What can we learn from history? Well, we learn that empires, right, when they get to a certain amount of debt, something has to happen, right? If we look at the Roman Empire, there's a lot of stories why the empire fell. Some people say that it was because they were too spread out. They were fighting too many wars in too many places. Some people said that they were too big. Some people say that they continued to debase their money. They kept taking the gold coins and mixing other metals with them, mixing other metals, and eventually the soldiers just wouldn't take payment in their own currency. And when you don't have an army, a country, right, when you don't have a way to protect your country, it falls apart. And so the U.S. is currently running at around 123% debt to GDP. That's crazy. Think about it in family terms, right? If you're spending 123% of all revenues, of all gross domestic product, that's a problem, right? If your debt is bigger than your gross revenues.
Right, exactly. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is the golden rule, the second golden rule, right? This one is he who has the golden rules. And we have a book today that will help you understand that from wisdom that is thousands of years old. It's called The Richest Man in Babylon. We love to put this book in your hand for free, no obligation, to the next 5 first-time callers at 800-725-7616 for your free copy of The Richest Man in Babylon, which is going back to wisdom from decades, from Babylon way back when, BC, and that wisdom from this man that gave advice to his friends and family that were interested in how can I become rich too. And it's basic truths that will help you understand and go forward. You can have that book for free by calling us at 800-725-7616. 800-725-7616. The next 5 first-time callers, 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And this Father and Son team is coming to help educate you so that you can make smart and wise choices. Daniel, why else did gold hit $4,000 an ounce and potentially still climbing? Right?
Yeah, Triple A. That's a really good question, because we talk all the time about generating income, creating income streams so that you can survive, right? You can survive. We talked about that period of time from 2000 to 2013. You had 2 crazy drawdowns and you made no money. That doesn't work in retirement. It's the same thing with gold, right? Gold goes through these cycles where in 2011, gold hit a peak and it didn't get back to that peak to somewhere around, I think it was 2022, 2021, 2022, 2023, somewhere in there. It might have been 2023, but that's a long time not to make any money. And if you need to live off of your nest egg, which most people do, or they need to take some portion from that, you cannot have a period of time of 10 years that are flat markets, let alone having drawdowns in that, unless those assets are paying you. But we understand at the same time that over time, governments get a little crazy and they debase their currency. And you and I have been talking about that a long time.
We've
been talking about this debasement trade. We've been talking about putting monetary hedges in people's portfolios. And now everyone's talking about this debasement trade. What's the debasement trade, right? And that's another reason why gold is going up, because people are saying, how do I protect myself from governments printing more money than they have? For governments, it's been a known factor for a long time. 2% inflation a year is good. That's what we all think. We've been taught to believe 2% is a year. That means your salary goes up every year or every couple of years.
Acceptable. Not necessarily good, but acceptable. 2%.
They like it because assets go up. Your house, would people be happy if their house stayed the same value or went down in value?
Right. Okay.
Right.
Okay.
So we've
Touché.
been taught that that's good. That's what people say. You need 2 or 3% inflation a year because then your house goes up in value and the government can borrow debt and it pays itself off. And this is a really difficult thing for people to understand. If you have a mortgage on your house at 3% and the currency is debasing at 3% a year, they're paying your mortgage off for you, right? If it's more like an 8% debasement, they're really doing it. So that's a hard thing for people to wrap their heads around, but it's starting to happen. And people are saying, how do I protect myself from not 2%, but an 8% or whatever we've been rolling at for the last few years? How do I protect myself from that? And when we look at S&P, it basically keeps up.
Right.
You know, your dollar basically purchases exactly the same as it did 15 years ago or 20 years ago. You didn't get any purchasing power, right? You didn't make any real money, real purchasing power. So people are saying, how can I protect myself? And gold historically has been one of the absolute best ways to protect your purchasing power, to protect from a government on a, let's call it a spiral. And let's get into that spiral quick here because this debt doom loop is super, super important, AAA. People are listening on, it really needs to understand this. It works like this. You run a deficit, so you borrow some money, right? The government's short $1 trillion a year to pay the bills, so they borrow $1 trillion. They borrow $1 trillion, which means they have to pay interest on $1 trillion. They don't have money to pay interest because they were already short $1 trillion. So now they have to borrow money to pay the interest. People see that they're short $1 trillion and now they're borrowing to pay the interest on the debt. So they say to the government, you need to pay us more interest for the next money you borrow. So now they borrow money for the shortfall, for the interest, and now they have to borrow more money because they have to pay a higher rate, right? Now they need more money because now they're paying a higher rate. So they borrow more money and then they have to pay interest on that money. And then people say, oh, you need more money or higher rate. And it's this doom cycle. You can't get out of it because the problem compounds on itself. And this debt doom loop is really starting to roll as rates have gone up. When rates were 1%, the government could borrow at 1%, 2%. It wasn't a big deal. But now when it's costing them 4 or 5%, this is a big deal. And it's creating this that there's no way of getting out of except by cutting spending or drastically lowering rates. And neither of those seem to be happening at this point in time. We want both to happen, but the current administration hasn't been able to get either to happen so far.
And the other way, there's a third way, right? Isn't it? Which is of devaluating and changing the value of or changing the currency, right?
Correct.
And any way you look at it, it's stealing from, in our case, the American people, because it's making their money worth less. It's another tax, you might say. Even though it's not officially a tax, it comes back to bite us. You're listening to Financial Strategies with Andrew and Daniel Agemy. Glad to have you with us today. And we are excited to be able to educate you on these things. And one of the things we want to educate you with is, can you retire? When can you retire? How do you retire? We are able to help you understand the date that you can retire, or if you can retire, what you need. You know, it's not that you need $1 million, $2 million, $5 million. Daniel referred to this earlier when you retire. What you need is a paycheck to replace the paycheck that you're no longer going to get from your employer. You need income. And because you don't want to spend your $1 million, $2 million, $5 million, you want to spend the interest and dividends, or most people do, so that you don't outlive your money. Greatest mistake people make is not switching to the I model soon enough, and thus they run out of money. So we can have this conversation with you, and we have an analysis called the Retirement Risk Report that will help you understand what your investments would do if the market went through another 2008 or financial crisis, or even a run-up like it did in 2013. We have this information where we can actually put solid numbers. This is not fact based upon fiction or fiction based upon fact like Monte Carlos do and that kind of thing, folks. This is looking at your portfolio, what it's going to do if you retire today, or how you can change things to make it better if you want. So if you want to have that retirement discussion, call us at 800-725-7616. No obligation and no cost, 800-725-7616, and ask for the RRR conversation. Retirement Risk Report, RRR conversation. Okay, call now.
Time for some tough questions for these financial advisors. What makes retirement income source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love.
We gotta talk to these guys. We're done here.
This is Financial Strategy with Andrew and Daniel Agemy.
And we're back. Welcome back to Financial Strategies with Andrew and Daniel Agemy. And we're talking about the golden rule. He who has the gold makes the rules. And, I looked back at gold 2 years ago, decades ago, and I was looking at some different mutual funds for gold and noticing that they would be worth nothing, then they would spike up, and then they would fall to nothing, then they would spike up and fall to nothing, spike up and fall to nothing. And I thought, this is crazy. To invest in gold, you have to know when to buy and when to sell. Buy low, sell high, which is the whole thing about investing. Buy low, sell high. But when do you know that it's high? And that became very problematic. It was not a thing that you could just buy and hold. Well, the thing that I didn't realize when I was doing my research on that with the gold mutual funds, it's typically not gold. It's gold mining companies. And gold mining companies are a whole different breed, a whole different investment. And they go belly up, and then there's all these kinds of things that happen to them. But there's various ways to buy gold. And one of the biggest mistakes of buying gold is buying gold in a typical mutual fund for this very reason. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about gold and the golden rule. AAA, those that hold the gold make the rules. And we have seen record flows of gold going into one huge buyer. Nobody knows who it is. I wonder who that might be. Maybe it's the U.S. government trying to get some of that gold. But for years, we have been seeing the other countries like China, India, Turkey, just buying gold as fast as they can get it. Russia buying gold as fast as they can get it and producing it. China produces ridiculous amounts of gold, and they send it to their central bank. And so when people talk about the smartest money in the world, I think a central bank is probably the smartest money in the world. Maybe not. I'm sure there's some hedge fund managers out there that would say they are. But when you control the country and you can do whatever you want, you're pretty powerful. You are pretty high up there with the smartest, at least in the know people. And so when we see central banks accumulating gold like that, what does that tell us? Well, that tells us it's probably...
They're going to make the rules. They're going to make the rules.
They're going to make the rules. Yeah, exactly. So, AAA, you were saying how there's different ways to own gold, right? The mining companies, you can own physical gold, you can own an ETF that owns gold, and we're always talking about purpose. What is the purpose of your money? And that's why typically we're working with retirees and people who are very serious. They can taste retirement. They're serious about retiring. And purpose is super important for them. That's why we talk about gold and we talk about these monetary hedges so much, because it fits into the bucket, that purpose bucket. What is your purpose? And there's different ways to own it. So you think we should go over some of these different investment vehicles and what purposes they fit for different types of investors? Or did you want to cover something else here?
You know what I think right now, Daniel, if we have time, we can maybe pick that up at the end. But right now, I think we should get into maybe alternatives to gold, right? Because some people might say, well, I missed out on the gold rush kind of thing, right? I mean, gold in the past couple of years, gold has doubled. Doesn't mean you can't make money in gold, but the strategy, this show is called Financial Strategies. It's about the strategies, not about the investment. It's not about investing in gold and how you invest in gold per se. It's about the strategy that you use with the investing in gold or other things. We always have people asking, well, what alternatives are there to investing other than the stock market? And so I would like you to get into some of that, because I see you as being one of the primary people as far as being able to do phenomenal things when it comes to alternatives for our clients.
Okay. Yeah. So like we said, you can own the physical gold, and that's typically buying for insurance that you keep in your possession, right?
Yeah.
And you can buy the gold ETFs. But the difficulty comes in is that there's these long periods of times where it's down and doing nothing, 10, 15 years of down and nothing. And it frustrates people so much. And they typically end up selling before things get going. We had a client like that who saw all the monetary debasement, saw gold should be going up, was buying these things and not making money for years and years and years, and just getting frustrated. How is this not working? Right?
Right.
I'm buying the biggest miners. They should be printing money, and they're not. What is going on? And you hold for 5 years and don't make any money, and you get tired of doing it. So what is an alternative? What is an alternative where you can make money in all cycles? Now we're in a new spot where these people have been holding for years and years and years and never made any money. And now they're up 100 and 200%, and their heads are blowing off because they don't know what to do. They're not like these tech guys that are used to making 100% a day. You know what I mean? Like, they don't know what to do. And gold is at $4,000 an ounce, and they've dreamt it was going to go to that. They've dreamt it's going to go to $10,000 an ounce, but now they don't know what to do because they're finally making money, and they've seen red for so long they don't know what green is.
Exactly. Oh man, you're getting in a can of worms. Well, let's you listen to Financial Strategies with Daniel Agemy, because people don't know what people don't know. And we want to educate you so that you can make smart decisions by knowing and or at least, very least, knowing what questions to ask so that you can get the information you need to make smart decisions. And today, one of the papers that we have put together for the show that was going to help you with that is, because all the time people are saying, how can I retire? How much can I retire? Do I have enough to retire? We have a paper that explains, have I saved enough to retire? How much do I need to retire? Have I saved enough to retire? This paper will help educate you to see where you stand and what you need to know. We love to put this in your hands for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Have I Saved Enough to Retire? Ask for it by name. Have I saved enough to retire? 800-725-7616. You listen to Financial Strategies. Today's topic is the golden rule. He who has the gold makes the rules. And so, Daniel, you started going into different ways that people can invest as far as the typical for everybody, right? Individual gold, right? Real hard gold, mutual funds they can invest in, right? But you started to talk about alternatives to investing in gold and other things like that. So let's continue with that.
Yeah, so to avoid that whole thing that we just went through and trying to have to time the market perfectly and understand these cycles, what we like to do is we like to invest in the royalty and streaming companies. And now, in my opinion, these things are the best business model on earth. And when you went talking earlier, you were like, how can we start one of those? Because they're just that good. They're just that good, right? You don't know what your margins are going to be with a regular mining company, because typically gold prices go up when there's inflation. Typically, gold prices go up when there's money debasement. Well, what does that mean? That means your labor to pull it out of the ground goes up. That means your dump trucks go up. That means your earth moving equipment goes up. That means your insurance goes up. Everything, your fuel goes up. Everything goes up. So you don't know what your margins are going to be. And that's why miners have historically been some of the absolute best destroyers of your money.
And that's why the mutual funds that I was talking about would go
they
up
own a bunch of those. They own a bunch of those, and then they throw in their own fee on top of that to pick them. And if you don't own them in the right time, now if you own them in the proper time, in the up cycles,
right,
your face can get ripped off with the upside. The difficulty is you have to own them in the up cycles. Now, these royalty and streaming companies, their profit margins are insane. It's 50, 60. Some of them can have higher than that profit margins, right? Percent profit margins. So when the gold price goes from $2,000 an ounce to $3,000 an ounce to $4,000 an ounce, that's all profit. Let me say that again. Their expenses do not go up because they made a one-time investment, and then they get a percentage of all profits from the miners. So they give them one-time $100 million to get a stream, 2% of all future revenues. So when the gold price goes from 2,000 to 3,000, that's all profit to the royalty and streaming company. And then when it goes 3,000 to 4,000, that's all profit. So we talk about how great gold has done over the last 25 years, and it's done fantastic. Well, one of these royalties we like a lot, wheat and precious metals, in the last 10 years has done half of what gold has done over the last 25 years. Just in the last 10 years. And the 10 years haven't been that great in gold, right? Compared to the full cycle.
Right.
And so when we talk about monetary debasement, where we talk about governments trying to print themselves out of a hole or trying to debase the currency, as you said earlier, AAA, there's a third way to get out of that doom loop. And it's to create a lot of money. So it deflates the obligations that you have, and it's theft. But if the S&P is 1 for 1, every unit of debasement, the S&P gives you 1 unit, then you just stay the same. You never actually grow your money. You have the same purchasing power. And if gold is 1 for 1, then you just stay the same. Not good. What I've seen with these royalty and streaming companies, for every 1 unit of debasement, you typically get 2 to 3 units of growth.
Wow.
Which means you don't have to have your entire portfolio in the royalty and streaming companies. And you don't have to time it properly because you can own it through the whole cycle. They're always making money. They just make a lot more when we go through these cycles. That doesn't mean that they don't have volatility. But if you mix that with a good income portfolio, then you're constantly getting income you can spend and you can support your lifestyle. And then you have these things we call monetary hedges, these royalty and streaming companies that are protecting you from governments stealing from you.
Right. And how we do that for our clients is active management, which we'll talk more about later. But active management is key. It's kind of like the idea of buying low, selling high. And because we're actively managing this, we see when to sell, when to buy, and all these kinds of things, which just can compound people's portfolios. You know, it's like everybody says, well, if I had bought Amazon in 2000 or Apple in 2000 and not done anything with it, but how did you know to buy Amazon or Apple? And maybe you would have bought, if you did that, you could have, what if you could have bought 10 other stocks that would have been in the toilet right now from that standpoint. So how do you know? Well, that's where the active management comes in because of the education that has been put into understanding what to do and taking more of the emotion out and putting more of the analysis in. Like the one show that we did was it's mathematical, right? So you listen to Financial Strategies with Daniel Agemy, and we've got a lot of good stuff for you still yet to come. But before that, we want to just let you know that we have this checklist today. We have a checklist we'd love to give you, Retirement Readiness Checklist. And what this is a checklist to go down to see, are you ready for retirement? And, if you are, all the boxes will be checked, right? But if you're not, the boxes won't be checked. And we can help you check those if you'd like. But you can have this checklist for free for your own purposes, for your do-it-yourself purposes. Call us for free. Call us, no obligation, 800-725-7616. Ask for the retirement readiness checklist. Today's checklist, okay? 800-725-7616. 800-725-7616 for your free copy of the retirement readiness checklist. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
AAA. So the question everybody wants to know is, where do we go from here?
Yeah.
We've had basically a straight run up from 2,000 to 3,000 to $4,000 an ounce, especially that 3,000 to 4,000. It took some time to get from 2,000 to 3,000, but from 3,000 to 4,000, it was almost a straight line up. And the last few days, we've had some pretty strong sell-off in gold. I'm Daniel Agemy.
And I'm Andrew Agemy. You listen to Financial Strategies with Andrew and Daniel Agemy, talking about the strategies for retirement. And because people don't know what people don't know, today's topic is the golden rule, the second golden rule. He who has the gold makes the rules. Daniel, this has been an interesting show, in my opinion, where we're talking about gold. And, for those of you in our listening audience, we talked about gold several times in the past. You can look us up on our website, agemy.com, agemy.com, or any place that you listen to podcasts. Does the belong in your retirement portfolio was one of the broadcasts that we did. And the other one, let's see, it was, should you go for the gold? Should you go for gold? What retirees need to know. And those are additional shows that you can listen to help educate you further on this for things that we may or may not be going over today. But of course, this will be available in podcast form after it airs. So Daniel, you've been talking about alternatives, ways that people can buy gold. So, people can obviously go buy gold. You can go to Walmart. Online, Walmart, you can buy, gold coins on Walmart, right? So people can buy physical gold, but there's a problem with that. Warehousing, storing the physical gold. Where do you put it? In the can in the backyard? In a safe in the house? Where do you put it? All right. So there's other ways to buy gold, right? And that first way that I said is probably one of the best, easiest ways to buy gold, because you buy it with after-tax dollars and you're in control. Whereas if you bought gold in an IRA, there's many more restrictions that the government puts on it. You can buy gold. You can buy paper gold, so to speak, by buying stocks in GLD, the ETF, right? Or other things like that.
Yeah, AAA, there is lots and lots of ways to buy gold. And maybe we can get into some of those ways. But I guess the bigger question, though, is should you buy gold? Because look at this run up. And as we talked about earlier, a lot of gold bugs, people who have owned this for years and years, they've seen red. Their portfolios have been red for the last 10 years, for the last 5 years, right? And now these miners are finally starting to take off. They've seen hundreds of % returns just year to date. And people are saying, maybe this is the end. Maybe it's time to take profits. Not to mention the last few days, we've had some big sell-offs in gold. So where do we go from here? Where do we go from here?
That's the big question, right? Well, and that's why I asked, what alternatives people have? What ways can people invest in gold without necessarily taking on the risk of, I buy it at 4,000 an ounce, and then, with my luck, it will go down to 3,000 an ounce, right? And there's going to be another 25 years before it's even worth 4,000 again. I can hear a lot of people when they listen to the audience saying that, but potentially. I mean, inside me, that voice is inside me saying that. What's the strategy? What's some good strategies to use here?
That absolutely could be. It could be 4,000, and it takes us, another 20 years. We have a come down back to 2,000. It's another 20 years before we get back to 4,000. There's a lot of ways to measure the price of gold, right? One of those ways is we could look at all, the U.S. monetary base. We could look at all money and look at historical ratios, what gold price is measured in dollars from different periods of times. And if we do that, gold might need to go to $10,000 an ounce. Some people look at other measures. They might look at it from the 30s to the 70s. And in that case, it might need to go to $25,000 to $30,000 an ounce. Some people use different ways of measuring where they think it's going to go next. You could look at the cycles, and you could see the cycle of what gold did from 72 to 80. And look at the percent returns. And then you could look at the cycle from 2001 to 2011, and you could see what it did that time. So if we're on track for one of those, maybe it gets to $8,000 an ounce. We still have another doubling perhaps for that. So there's these different ways to measure where it's going to go. And the biggest thing is, can governments around the world get their spending under control? Because if they can't, then they're going to print more money, which debases people's dollars, yuan, whatever they're spending in rubies. It debases that. It debases money, which gold doesn't move. The price of gold doesn't change. 1 ounce of gold is 1 ounce of gold. What changes is the thing you're measuring it in. So it's not that gold is going up in value as much as the thing you're measuring it, the dollar or the ruby or whatever it is going down in value. It's taking more of those units to buy the same ounce of gold. Gold didn't change.
Right.
And if we continue to debase money, that means it will take more of whatever you're spending, dollars in our case, to buy that same ounce of gold. So is 8,000 in the cards in the next 2 to 3 years? Based on the monetary debasement that's happening, I would say that it's probably likely we could see $6,000 to $8,000 an ounce in the next 3 to 4 years.
Wow. You're listening to Financial Strategies with Daniel Agemy. Today's topic is the second golden rule, right? He who has the gold makes the rules. We want to help educate you so that you can make smart decisions. Going along with that today, we have a book we love to put in your hand, which will help dig into deeper the philosophy behind what we're saying here today. It's called The Richest Man in Babylon, taken from scrolls written BC, before Christ, right? And with that gives great education and wisdom, long time, tried and true wisdom for how to be able to invest in with the right mindset and philosophy. Love to put this book in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy. Call now. Daniel, when you're talking about this, in my mind, when we say, well, where do we go from here? The biggest thing that people in our listening audience need to take into consideration is, what kind of investor are you? What are your goals for your money? What are you trying to do? Are you trying to have a good retirement, or are you trying to have a legacy for your children and grandchildren? Because if they're going for a legacy, buying gold today, $4,000 an ounce, may not be a bad deal. But if they want money in retirement so that they can retire and stay retired, that's probably not the best way to go. And that's where the alternatives that you have spoken about, will speak about, come into play in my mind. And investing, like we were always talking about, okay, here's Jay, my friend Jay listening. I know you're listening, man. So here's a thing for you. TR equals I plus G. What's it stand for, Jay? Okay. Total return equals income plus growth, right? Interest, dividends, income plus growth. So if you want your retirement to be stress-free, you need to invest more for the I rather than the G. The gold is more of a growth play because there's no income from gold. Now you can sell it, but then you're selling your gold. And it's like a Roth IRA or various other kinds of investments. If you sell it, then you don't have it anymore. And what do? And like you said earlier, when we were talking, right, if we bought gold in the 70s for $200 an ounce and sold it today for $4,000 an ounce, well, what are we going to do with the money? What are we going to put it in to stay up? Well, why don't just leave it there, right? If we're trying to stay up with inflation and trying to be a long-term legacy aspect, what kind of investor are you? And going along with that, you folks that are listening, are you an aggressive investor or a conservative investor? Can you stomach what gold may or may not do in the future? Are you a speculative investor or are you speculative or are you an investor where you actually want to make money on your money? Do you want to just see the numbers on your statement go up or do you want to actually get a check? That's the big thing. Now, if you know, here's a warning for you. If you know what kind of investor you are, but your advisor uses different definitions than you use, watch out. Definitions are a key to your investment. What do you mean by the word conservative? What does your investor mean by that? What's the definition of that? Very important to be on the same page. But Daniel, where do we go from here?
I agree with everything you said, AAA. You need to know the type of investor you are. If you're that speculator, then you're probably wanting to trade those junior miners and get your face ripped off and have some fun doing that. But you really need to know what you're doing to do that. If you just want legacy, you want to protect purchasing power over a long periods of time, then you own gold. You don't buy gold and you don't sell gold. You own gold. It's part of your constitution. You get the physical stuff, you keep it in a safe place, and you don't care what the price is because you know in another 25 years it's going to be worth a lot more. And if you're not around, your kids are going to get it. And if they're not around, the grandkids are going to get it. And you hold it as protection against what we know is going to continue happening, and that's money debasement. And if you want a reliable investment, then look at these royalty and streaming companies. And if you don't know which ones are good or how to incorporate them into a portfolio, that's what we do, right? We incorporate them into an income portfolio. We talk about these things all the time. They don't pay big dividends, but they generate huge amounts of income. They fit into the income model that we're always talking about. The difference is they're taking the income and they're going and buying more streams. They're reinvesting it. They're not paying it out to you, which means you get more income, right? Or they get more income and then they go and they buy more. They have no debt. They're just using their income to fund and to grow and to fund and to grow. And that's why they've outperformed gold by a wide margin. They've outperformed S&P. They've outperformed the gold miners on long periods of time because they're such good stewards of capital and because they're creating income. And when you mix that with the income, a good diverse income portfolio, what ends up happening is it's a rules-based approach where when these things get expensive, they get sold down because they get too big in the portfolio. You take that extra cash and buy more income producing things. And then inevitably when there's sell-offs in the gold market, they're lower in the portfolio and all that income goes into buying more of these, and they work hand in glove together to keep a balanced portfolio, but also a portfolio that can protect you from market downturns on the income side and asset or monetary debasement on the royalty and streaming side of the equation.
Yeah, Daniel, that goes along with the offer that I have as we finish up the show today. If you're in the listening audience and you're asking yourself, can I retire? When can I retire? Those are great questions to ask, and we'd be glad to help you answer those. And using strategies like Daniel just went through, and thought processes and an analysis like Daniel just went through, we would be able to answer those and help you with that. If you want to have that conversation, we call that the RRR conversation, the Retirement Readiness Report conversation. If you want our conversation, please call us 800-725-7616. No obligation, no cost to you. 800-725-7616 for your free RRR conversation. Listen, if you want your retirement to be stress-free, invest more for the I rather than G. Until next time, God be with you.